from Paul and Andy and myself about how markets actually operate. But now what we want to look at for this session is how we can get some trade setups that we can use in any time frame and in any market. The purpose of this event, of course, is to teach you how to identify chart patterns and make money with those chart patterns. Now, I know a lot of people out who are signed up for this webinar have never seen VSA before. Some of you here may never have been familiar with what volume spread analysis is. But why have we just talked for 2 hours about market manipulation, and what is the connection to Richard D. Wycoff? Well, here is the direct connection. Over 100 years ago, Richard Wycoff said that the market was moved by the composite operator. Now, what is the composite operator? The composite operator is the consensus of opinion amongst the professional institutional money. And because they move the market, as we've already heard about, we, as traders, have to be able to identify the footprints that they leave. When a market is moved or manipulated, whatever you want to call it, there will be two key areas that we have to look out for. Now, number one, I've already given you a clue that ultra-high volume or Yao Ming bars are incredibly relevant to your trading. In fact, if you see on any time frame ultra-high volume, and it has to be ultra-high. If you see high volume, it's high. It's as tall as me. But ultra-high stands out. Now, I'm going to give you an example now of how your thought process will be totally thrown as you're about to take a trade. I'll prove it to you, because I know several people who have now become customers, one of them's in the room here, who saw my comment about this chart the day the news came out. Some of you might remember it. I was in the VSA club, and I put up the news that had come out that day, and I actually, in the background, had the news, the TV on, just to hear what was going on. Now, imagine you're sitting there now. It's the 14th of April this year, and the earnings season is upon us. And what we see is a great news report here. JP Morgan Chase reports 3.3 billion in profit. Profits at JP Morgan Chase jumped 55%. That's significant. Now, immediately, any equities trader that's uninformed, which of course you are not, but any uninformed equities trader will probably then switch on the Mad Money show, CNBC. They may switch on, Bloomberg. And what we'll hear, what will happen, and the reporters are not lying here, they're going to be saying, the stock here, let's look at this chart. Stock's moved up, it's gapped up here, or everyone's buying it, professionals. We go to the floor of the exchange, there's someone looking up at the camera, oh, everyone's bullish this stock, it's great news, this is going to lift the banking sector. All of that will be right in your face. And yet, as you see that, VSA and Wycoff will be telling you this is probably a great place to short this market. Now, I'm going to show you a better place, a safer place to take a short after you see supply entering the market on good news. Tom Williams, when he taught me, said, Gav, the best way for you to trade and to learn is to lock yourself in a dark room with no TV, no windows. Earl's smiling here. This is probably right, though. Look at the chart. If no one influenced you, no brokers ringing you, no TV, no newspaper headlines, and just the chart, and all you relied on, the chart, he said it would be very difficult for you to be a losing trader. However, because as human beings we have emotions and senses, we have our hearing, we have our eyes. And just as you watch me now, there will be something going on in your psyche, you'll be influenced in some way. Well, when you're watching the news, you will also be having a gut reaction to what you're seeing. And an example, a pilot that is now a very successful trader, BA pilot actually. I think, he's here. But I remember him saying to me, I actually was on his aircraft, and he came and met me, and he invited me up to the first class galley, and we got talking. And he said, you know something, Gavin? He said, until I came across Wycoff and you guys, and I read Tom's book, I couldn't understand why every time I seemed to take a trade, it was like somebody had a camera over the back of me, had watched me do it, and said, there you go. Has anyone, put your hands up if you've ever had that feeling that someone's watching you? Yeah. Just so you know, everyone's sort of, raising their hands. There's a reason for that. No, it's not that, by the way, just so you know, this is not a conspiracy. There isn't a camera over everyone's shoulder with them watching you. But what's happening is professional money understand how the herd operate. So what they know is that on good news, such as this, JP Morgan, they have an opportunity to sell back to the herd at the very top of the market. This happens on a 1-minute time frame at the right place. It's got to be at the right place. It happens on a daily chart, a weekly chart, even a monthly chart. If you see something on a weekly or a monthly chart, it's going to move the price much longer or faster or bigger move than you see it on a 1-minute chart. But this is where, when Tom was teaching me, I said, that doesn't make any sense at all, Tom. You're telling me that the principle on that 1-minute bar on the S&P is exactly the same as the principle on the weekly oil. He was right. It is exactly the same, because the market moves on the laws of supply and demand. That's the key law. Everybody talks about that. Everyone accepts it. They say oil, supply and demand. Housing, housing's falling. There's too much supply there. But there's others. There's 2 other laws there. And I'm sure David and as you know, the Wycoff experts, Gary and the 2 Garys, will talk more about this. But you've got cause and effect, and effort versus the result. And all of those things are there on a chart if we can find them. So we'll start off by looking at the top of the J. This is the stock chart that I just showed you. Now, several things on this chart are very, very apparent. And there is a principle, a 3-bar principle here that I showed you earlier on the oil market and on the sugar market. And it's right here in front of you. Now we'll start with this bar here. Now look at this bar compared to the previous several days. What would you call that bar now? Yao who? Yao Ming. Exactly. That is a high volume compared to the bars behind it. It jumps out at you. Do you all agree with that? Just yes or no? Yeah, everybody sees that's very high volume. Now at Trade Guide, we talk about volume spread analysis. But if in America, we should term that volume range analysis. Because what we're looking at is relative volume compared to the previous few bars. That's important. But a trade setup is not, and I don't think I've said this before, but a trade setup is not just taken because we've seen a signal on 2 bars. It has to unfold like a story. So when you see ultra-high volume at the top there, can anybody tell me, I know Tom Williams would short that, but I'm going to tell you not to. But could anybody tell me why you wouldn't short at that very top? Anyone got any ideas? Yes, sir. Well done. Great job. I knew you've been to some of our seminars before too, but absolutely correct. You've actually got an uptrend, and in fact, Trade Guider has as you know, for those of you who've got the software, has a clear system, if I put it on place here, and this is now built into the e-signal charting package as well. The trending system, which is proprietary, the diamonds, and the blue bars, they designate an uptrend. Now, Tom Williams will have taken the trade at the top there. I can guarantee it. And in fact, in our live trading room a few weeks ago, I took a trade, 2 trades. Rob, you remember this. This was when you were going, oh, it's right at the top of the trend there. I'd want to see a reaction. But I shorted the pound on a principle, but I picked the top. It came off. I'm going to show you a better place to take a short trade. So you might want to write this down. Rule number 1, identify ultra-high volume up bars and consider them weak until proven otherwise. There is an exception. Okay? So when you see ultra-high volume up bars, consider them to be weakness unless proved otherwise. And there is one exception. I will tell you that 8 to 9 out of 10 times they will be weakness. Why? Because professional money has to sell into up bars, which is why weakness, when it appears on an up bar, a bar that has closed higher than the bar behind it. When we look at a stock or a commodity like sugar or oil, the news from the analysts that work for the major banks are not there for your benefit. And as Tom told me, he said, look, Gavin, if you had a real bargain and you knew that there was a Ferrari for sale for $5 and it was totally genuine, and there's only one of them sitting outside. He said, are you going to tell your whole audience that there's a Ferrari downstairs for a $5? No, you're probably going to go down and take the deal. So that's very important. Now, let's consider the psychology of that bar that we're looking at. Now, just so you know, it's the same day as the news announcement, and it produces what we call a supply coming in. That means sellers are starting to attack the price. Supply is selling, overcoming buying. That's why when we see supply coming in on that bar, it's gapped up. The range of the bar is increased now from the bars behind it. That's the high and the low of the bar that we see here. It's closed just off the high, and it tells us that there's increased volume here. And if we read the description that Tom wrote, it says this is an up bar showing an increase in volume, suggesting supply has entered the market. If volume is ultra high, this could be climactic action. When you see Yao Ming bars, they are most often climactic bars, which means a potential change in the trend. Sometimes this can be a breakout through an old top, which is a sign of strength. However, make sure that it is not a false breakout, and I'll show you how we confirm that in a second. For those breakout traders who want to know if these breakouts on good news are genuine, the next 2 bars confirm it cannot be, and you should be ready for a short. Now, at the time, over those 3 days, the news that you hear will definitely make sure you don't think of shorting that. In fact, the news will infer that this is going up and up and up, just like the oil market. So I want you now to focus. We see here it tells us, look at the background carefully. What does that mean? The background of the chart. That's quite important. We need to look at that. Do you have strength or weakness behind you? After a period of rising prices, this could be the start of distribution. Now, that is a Wycoff principle. Wycoff talked about distributing at the top, i.e., giving back to the uninformed at higher prices something they brought at lower prices. Let's say I've got Earl's card over here. This is Earl's business card. Let's say that this is extremely valuable. Okay, let's say there's only 5 of these in the world. And I want to make sure, or let's say there's 100 of these cards, and that card is valued when I bought it at $1. But what I want to do is, I don't want to sell that for $1. I want to sell Earl's card for a minimum of $100. So how can I do that? How can I achieve that? Well, first of all, what I want to do is give the impression that that card is worth at least $100, and then show, as I'm moving the price up, that we're running out of these cards, that there was 100, now there's only 50, now there's only 40. And all the time I'm doing that, the human reaction is, oh, I'm missing out on, I need to have that card. And when it gets to the top, after buying it at $1 to the $100 mark, I'll create a frenzy for these cards by ringing up the media, whoever. Create a frenzy for Earl's cards because I brought them at the bottom here. And at that point, it's got JP Morgan here. The news that we saw infers on April the 14th that this stock is very bullish. And most traders who watch CNBC would be bullish. Most traders who bought the Wall Street Journal on that day, go and check it, would be bullish because everything you see is rising prices, great news. Why on earth would you sell something here? However, this is where we then see what happens the next day. The price goes up, but I want you to focus now very closely on the range or the spread of the bar. Now, what do you notice about that range on that bar? Who said small? Well done. It's narrow. And the software actually will tell you, when you see a narrow range or an average range, that is narrow compared to the bars behind it. Where does the price close, however, on that range? Top, middle, or bottom? Okay, and the volume is lower than the bar behind it, but still I couldn't get an entry. Again, why couldn't I short that at that top? Any ideas? Still an uptrend. Benefit hindsight's a wonderful thing. That's still trending up. But I have got alerts, a big alert, that actually there is something going on here. Now, look at the volume on this bar here. What do you notice about that? It's Yao Ming. It's incredibly high Yao Ming. And it's come down to close on the low of the bar, as we can see down here. And the next bar closes lower. Now, it produces a green indicator in TradeGuider, because TradeGuider sees this bar here as potential strength, but you don't rush in and buy there. The reason you wouldn't is you've got this immediately behind you now. You've got a widespread down bar. And the reason we have that widespread down on an increase in volume, it's even more bullish if it closes right at the bottom. Bearish, sorry, let me be clear. It's even more bearish if it closes right on the bottom of the bar. It's more obvious. And then if the next day it closes lower, that is your sign, get ready for a short trade. Because it tells us in that volume, the logic here, this is what they've done on that bar. Everyone who's brought JP Morgan at 47.50, 48 and is expecting higher prices has probably got their stops just under here somewhere. Now, what professional money want to do is lock you in or out of a position. In this case, if you're long, suddenly you've seen the stock drop real quick. The news is telling you, don't worry. Don't worry. That's, they'll give you some excuse. And then a couple of days later, the price will start to drift up again. It'll start to move up. And you think, oh, God, dear, I was worried then. I thought that stock was going to come down. Now, what do you notice about the volume on that bar? What do you notice? Shout. Extremely low. If that is Yao Ming here, and that is Gavin Holmes, then this, I haven't got a picture of a jockey, but jockeys are usually quite small in England, the ones that ride the horses. So, yeah. I'm not going to point at Gary. Stand up a minute, Gary.
I am.
Hold on. This is Gary Follett. Okay. No, you're still not quite a jockey, but get in there. Give him a round of applause. But here's the thing. A jockey, let's say it's 4 foot, 3 foot, whatever the jockey is. Here, he's appeared on your chart. Is it on an up bar or a down bar? Okay, look at the spread. Very narrow. Okay, and what does the next bar do? Does it close higher or lower? Professional money who've already locked people in here have withdrawn their interest here, and the next bar closing lower the next day confirms that. You now have a setup appearing. You've got weakness in the immediate background. Okay? Do you agree that? You see, do you understand what you've got weakness on those two bars? Because on the high volume, they're selling. So you've got selling in the immediate background. You've now got confirmation on the widespread down bar. You go up on what we call no demand. There's a volume less than the previous two bars. But then, guess what? They're going to give you another opportunity here. An even better entry. Can anybody guess where's the best entry on that chart is to go short? There's a bit of a clue, by the way. Can you tell me? Of course it is. Yeah, the gentleman said no demand, and it's right here. And it's actually almost to the tick in the right place. Because if you mark the low of the widespread down bar that we've seen on extremely high volume, and if we reapproach that area and we see no demand at that area, it simply tells us that professional money at that price on that day have withdrawn their interest, and that's why the price is not going up. And the next bar confirms it. Now, how, if you ever see that setup, do you trade it? Do you short the no demand bar immediately at market? No. This is what you do. You mark the low of the no demand bar once you've seen it. And this is in any time frame. I'll show you this on a 1 minute S&P. I'll show you it on a Forex chart. I can show you it on many charts. The same principle. So,
are you saying this is the best place to go short?
Yeah, that's right. That's where I would short that chart. And how I'd trade it, David, is what would happen. I trade this very frequently, by the way. It's a setup I trade a lot. And here's what I would do, is I would put a sell order below the no demand bar so that if the market still drifts up on further volume, I'm not under pressure. And then I wait for the market to pull through to get me into the trade, and then let the market go from there. And then the trending system, which we have, which is, I don't think you've seen this, this is a proprietary thing. As long as the bars are red, the diamonds are red, and the H stops are above the market, I can stay short. Now, I can see exactly where you'd say here, well, now, if you're short, surely you'd want to be alert, because you've now got a widespread down bar closing in the middle, the next bar's closed level. Now, that is potential support there and potential buying. And we've got a test, but the test has failed, as you can see on the next bar. So I've got a failed test, which from VSA perspectives, and by the way, I'm addressing David Weiss, who's a wycoff expert here, and David's never seen Trade Guider before. It's the first time we've really showed this. So it'll be interesting when we look at David's presentation on the wycoff principles here. But this is an actual trade setup to the short side, very similar to the sugar market setup, which I showed earlier. This one? No. And the reason why, when you see a widespread down bar like that, you'll notice Trade Guider doesn't put a signal on it either, okay? Because the proprietary part of why you don't see signals on otherwise, on every widespread down bar and ultra high volume, you'd think that's going to automatically put climactic action on there. And there are times when it doesn't do that. And on this case, there is a reason. Look at the background of the chart. Look several bars behind you. What have you got? Here, these 3 bars. You've got weakness right behind you. Where you expect to have a climactic bar is after a serious down move of some proportion. And then it's got, I'll give you an example. The 9/11 attack, I think we've got a chart of that later. When the markets opened a few days later, the news was inferring that we're in a bear market, it was going to crash. Actually, it was the very opposite, and the market became bullish, not bearish, because professional monies were absorbing what was going on, and everyone on the news couldn't figure that one out. Suddenly they've got this terrible news, Al-Qaeda's everywhere, and the market changed from a steep down decline. They absorbed everything, and it went straight back up again. So as we've come down here, there's 3 areas of this chart that which make sense of this chart. And let me put for the audience as well, okay. So stage 1 of the trade, I see Yao Ming up bars. I've got unusually high volume, and the spread of the bar is narrowing. Okay, that's stage 1. Stage 2, there's a widespread down bar on very high volume after that area. And as we try to penetrate, as we go back up each day, the volume declines. So we have our first no demand bar. It's confirmed by the next bar. You could have entered a trade on that bar, and in fact, in our VSA club, that's exactly what happened. That's exactly what several customers did. So they're already short on this bar. The market comes down. Throughout there, we see what we call testing of the market, which are little narrow spread bars on much reduced volume, and then they fail because there's too much selling in this background. Now, if we miss the first entry, we get a second entry, which is even more obvious, and this time Trade Guider puts an indicator on it. Everything now is in favour for a short trade. You've got weakness in the background, you've got no demand in two places, and then actually, just so you know, 3 or 4 days ago, for those of you that know VSA, we have what's called an upthrust on low volume, a low volume, no demand upthrust. It's a thrust up for stops. Our stop management system would have kept you out of getting stopped out on there, and we come down, we test again, and we fail. So already here, you have a very specific, higher probability trade to the short side. Again, Tom would probably have shorted at the top there. Now, why would that be?
Can I ask a question?
Yeah, please do. If you've got any questions, shout them out.
The first blue bar that you circled with the wide range and the expanding volume.
Yeah.
Okay. You're saying that's a weak bar just because the higher volume coming into the marketplace?
It's a weak bar for several reasons. And you've got to bring it into...
What is it? Because as far as I know, that looks like a breakout bar.
Mhm.
Closing near the high, expanding volume. It's a bullish market. If the trend is up, I'm going to buy that bar.
Mhm.
And how do you know the next 3 bars aren't going to be $5, $6, $7, $8 higher?
Well, when you buy a breakout bar, and I'll show you something in a minute which will...
This part B of the question is, on that bar right there, if we don't know the future,
True.
okay,
Mhm.
and if I wanted to buy that bar, and you tell me, no, don't buy that bar, it's weaker,
Mhm.
and 3 days later the stock's $10 higher,
Mhm.
it's a little bit too late to buy the bar 3 days, you know.
Actually, no. If it breaks out and tests, it's a great place to buy it, and I'll show you in a minute where we do that.
Well, yeah, you can buy the retest.
Yeah. The question was, it's a great question.
If I'm a technical analyst and traders saying, well, why didn't I buy that, you know?
Yeah, no, it's a good question. Here's the question. The question is, look, Gavin, I know we're looking in hindsight. I appreciate that, but we do trade in foresight. And here's how you read this. And I'll show you. First of all, the news is bullish. So you've always got to be careful buying breakouts on good news. That's common sense. Secondly, how do we know at the time that that's a short trade? Well, I've already said 3 times I wouldn't short that. I wouldn't short that. I would wait. Now, there's only one place, and I said this is how you know. There's only one caveat where you know that's a genuine breakout trade. What happens is it's a VSA principle called absorption volume. It's high volume, so it doesn't want to be ultra high. It breaks out. The market falls to rest at where the breakout level is. And as it falls, which it will, because remember, we don't want to buy on up bars. Don't chase the market. You'll get killed. I don't buy on up bars. I buy down bars. And I'll show you what a test looks like. In a minute, if we come into this area where the red line is and we test it, that's a low volume, narrow range bar that closes in the middle or low near this level, and it refuses to break it, and then it takes off, you buy the next test. Not the first one, you buy the next one. The secondary or third test after you've broken out. Now, I'll explain that on the oil chart in a second, and then I'm going to get, when Paul's back, get Paul to come back in and show you the support resistance areas. But let me just demonstrate my point as to why these breakout trades catch everybody. Look, that's hindsight, but I called that one in the VSA club. I actually called that short trade. But there's another reason why. There's another reason why. Can you all read that? I don't know if you can all see this clearly here. I'll just try and see if I can highlight it here. Okay, can you all see the date? Can you see that? The date? Don't know if it's clear. It's October the 14th, 2009. Okay? JP Morgan scores big in latest quarter. Is that good or bad, do you think? Potentially bullish? Yeah, I'd say so. Banking giant enjoys rebounding key areas such as investment banking, even consumer credit. You know, great news, God. Come on, this is great. And this is come on, this is going to go up. It has to. You know, this is how the markets work. Surely, if you've got great earnings reports and you've got great news like that, the market should respond positively. Can everybody see the date of that bar that I'm highlighting on your chart? Can you all see the date? Yep. Can you zoom in for us? Yep. You can see that. Actually, you have to zoom out, Rob, because the date's to the left. Well, I'll tell you anyway. It's very clear. It's the 14th of October, 2009. Just to demonstrate that what we're telling you is correct, there's another strong sign of weakness. And you can see how far the stock declined. And that one was even more obvious because the Yao Ming bar was extremely high compared to the previous bars. This time, the spread is immediately narrowed. They gap it up. Notice how the market gaps up right behind it. And you know now on this setup, sir, you know that that's real weakness because the next bar closed lower at 46. But just look at the tight range of the bar. Okay, it's the low is 46.63 and its high is 47.47. That's a $1 range in a day on very high volume. There's only one thing can do that. For every buy order that the breakout traders are making, the professional money is saying, thank you, guys. Cheers. You've been watching the news. Oh, there you go. And that's what caused that to fall. And guess what you see all the way down here? All the way down here, as we try to go up to that old area, there's no demand bars, there's signs of weakness. We have a rule in Trade Guider where we say, hey, look, you know, if you see a red indicator after weakness and the trend is down, we don't see green and buy on the down bars. There's a better place. In fact, we always teach you at Trade Guider that you're going to buy down bars in an uptrend on lower volume. But the breakout traders consistently get their backsides handed to them on a plate. Rob, how often do we see this in our live trading room? We will sit aside and even people who just joined the room will be going, you guys are, you know, we've had a few things said to us. You've just missed the trade. And it goes up maybe by $5 or $6. And we know that if it's a genuine breakout, it'll get tested and we'll take the next trade. I don't care if I miss a bit of the action. I'm not greedy. I'll get an opportunity. But 9 out of 10 times, so what I'm showing you here is exactly what happens. You see the ultra-high volume on the up bar. You see it, Yao Ming bar, as I call it, and the market then comes right off and fails miserably. And when we talk this afternoon about how Wycoff would look at this, you'll be very interested to see that, you know, Wycoff recognised that very, very high volume coming in. He was calling it the tape at the time. You know, we look at the tape. But here we see, again, throughout the same area, 6 months to the day later. Is there any coincidences in the market? No. No, they're moved. They're moved. And does a stochastic help you there? Does a MACD and a moving average help you there? Doesn't help you at all. Because it's going to show you a buy. Of course it is. Because the price has been moving up. Which is why if you use VSA, volume spread analysis, and combine it with your technicals, if VSA says you should be short there, and one thing your other indicators are saying buy here, then you're going to think very closely before you actually go long. And if you remember the 3 bars that I gave you, over here, if you see that followed by that on 5 bars, you're ready to short it. Because now that breakout on all that good news was exactly doing what it was supposed to do. Catch you. And they did it 6 months ago. And things, it's just like, before I bring Paul in here, just so you know what I've been talking about here, Paul. We've just been talking about JP Morgan here. We've been talking about the weakness at the top that was followed by what we call no demand, which is low volume. So that's a specific entry. But then the gentleman asked a question. It's a very good question. Well, look, how do we know he's a breaking out trader? How do we know that's not a genuine breakout here? Well, the reason we know it's not genuine is because of these 3 bars here. They're a signal that professional money have locked everybody. All the breakout traders here are now in a very poor position on that bar. It's designed that way.
Well, it depends on if you want to be an aggressive trader or a conservative trader. It's like if you want to be an aggressive trader, go in but get ready
Yeah.
And what you just described as a more conservative and safer trade.
Well, Rob, we've met some aggressive traders in our time. We've helped a lot.
I'm going to tell you right now, okay, I've been doing this long before most of you in this room.
Hold on a sec, Rob.
Traders.
Come and stand up here just quickly. Sorry. Just very quick. But I want to bring Rob in here because the question was, this is Rob Hoffman, who runs a live trading room at Power Charting, real money, live trades. Both of us have students that follow us. Both of us have had people that have, made some very bad errors being too aggressive with the market. If you're too aggressive with the market will eat you alive. It's designed that way. If you're patient with the market, disciplined with the market, and have structured entries like we teach, then the market will give you a piece of its action. That's the way it's designed. But my goodness, if you're greedy, what would you say? Are you conservative or are you aggressive, Earl?
Both.
You're both.
I've taken both conservative and I've taken
That's a good. And I think I would say I've done that.
that mix. 'Cause
Yeah.
That's where I'm kind of at myself, actually. Earl.
Just briefly, just a description.
Just real briefly. 2 quick points here. I like more the mix. Being overly conservative all the time is not necessarily the right answer. Being overly aggressive, in my opinion, is certainly not the right answer. A healthy mix. There's times where I'll be a little more aggressive, but then you've got to have good stop management. You've got to have your backup plan. You've got to think. So many traders don't even think in advance. Where will my exit be? If I'm in the direction of a trend, where will I scale into the direction of the trend? Will I scale in at all? Where will my stop be? Am I going to use the same stop parameters on an aggressive trade as a conservative trade? They don't even think about any of those things before they go into the trade. All they do is they see it starting to, quote unquote, break out. They jump in there, and then as it starts bleeding against them slowly and bleeding against them slowly, they're like, what do I do? Okay. It's going to come back. It's going to go my way. I can't believe I've already done this 6 times this month, and I don't want to lose again. Maybe if I wait just a little longer, it's going to go back my way and pop back in the direction of the initial thrust. The bottom line is, I actually had a student of mine. We just recently had this conversation. Had talked about how before he'd come to me, he'd lost 75% of his trades that were breakout trades. 75%, those were his numbers, that he said he had lost on 3/4 of his breakout trades. And, when we talked about that in the room, so many people jumped in and reaffirmed that position. I suspect many of you in this room have all been breakout traders. And what I mean by that is I don't necessarily mean just a formal breakout, maybe a situation like this that we're looking at on the screen right now. I mean in general, where we see a little bit of momentum. How many of you here trade the S&P futures? Okay. Now, at some point in your career, if not even recently perhaps, how many times have you watched that market open up, the New York Open, and all of a sudden it starts to thrust one direction and looks really exciting, only to turn around a couple seconds later and thrust right back down against you, only to go ahead in a couple of seconds or minutes after that, thrust right back up into the direction that it was going the first time, okay? And that happens approximately, in my estimation, 15, 17 times a month. There's only roughly 1 to 3 times a month out of a 20-day month, trading day month, that the S&Ps will just take off and start going and not look back, okay? Most of the time, it'll whip into a direction, whip back, and just chew people up left and right. I show it. We talk about it all the time in my room, okay? And so the odds of going ahead and being, making money on that one day where it just breaks out and goes, okay, versus all the days you're going to lose money. And what I see the average trader goes ahead and does in a situation like that, they'll go ahead and they'll be chopped up so many times over the course of that 20 days, within that 20-day cycle, that by the time they go ahead and actually get a trade where they're making money, what do you think they do? On a trade where they're finally making money, what do? They get out quickly. Exactly. So over the course of the month, net, they've lost so much money on the breakout trades that when they finally get one that's making some money, they cut it short. So that as we look at the profit loss statement at the end of the month with that breakout trading strategy, net, it's not working out real well for them. So there's got to be some more behind the methodology than just snapping it at a breakout for the sake of it going ahead and being a breakout. I can't emphasize that importance enough. Many of you in this room have probably been in that situation, whether you trade the S&Ps or any other number of instruments, but the S&Ps are notorious for it, especially in an opening range, whipping back and forth. So many of you can probably relate to what I'm saying here. So the conversation with me, I'm always going to err on the side of caution and more conservativeness when it comes to like breakout trades. Okay, I prefer to wait for a breakout. Wait for a pullback. First of all, a breakout in the direction of a trend. Let me be clear. Wait, and then go ahead and wait for a pullback within that trend. I think that's a far superior entry, in my opinion, than going ahead and just taking a breakout out of a sideways congestion, which very often falls right back into the congestion. Okay, before the real move presents itself. Those are my thoughts.
Question for you, just before you go. In your live trading room, after speaking to the mic as well, in your live trading room, how many trades do you think you've taken this year since the 1st of January?
Tim's
Actually,
one of my
Tim,
students.
you're one of the students.
He is one of my students here in the room.
how many
Why
do
don't
you
you answer that? I'm sorry?
4 to 7 a day.
Okay, well,
4 to 7 a day.
You know, I mean, over the course of since January 4th, just guesstimate, just in your opinion.
Hundreds?
I mean, it's well over 100. We'll go. We'll go with well over 100, I guess. I would say.
I'll ask you, how many losing trades has Rob had in that time?
1.
Sorry?
1.
And you've seen him trade real money. You're not a plant here, are you? Just check that. There's skeptics out there.
The only reason he did that, he won against the French.
Yep.
Yeah.
So-
And you've seen me trade as well?
Yeah.
You probably saw me make a losing trade last week, but other than that, how many have I made?
Many.
Yeah, right. Yeah, good one.
Okay, but seriously, let's.
Yeah.
I'm sorry.
The longer the base is, the longer the cause, greater the effect.
The longer the cause, greater effect.
Well, I think what you're saying there, if
So you're
I'm
telling me you not the breakout from a long base is dangerous, but wycoff taught longer the cause, the greater the effect. So, like.
Okay. Well,
yeah,
I don't, if other people want to answer that,
we're going to talk.
The answer is yes. I wouldn't
Okay.
want to take
Yeah.
I wouldn't want to take a breakout out of a base.
Yeah.
Dangerous.
The initial breakout out of a base. I watch for bases. We talk about it. It's what I call the spring coiling in the middle of the day. The coiled spring is what I refer to it as throughout the day. We watch for that, but I personally do not take the initial breakout out of a coiled spring because.
Wide weight range bars kind of strain. You don't take them.
No, I personally do not. And you know what?
Yeah, but I really, like, I'm here to learn about wycoff. I'm not here to hear about how you trade a specific market, right? Or your belief system. But what does wycoff teach?
Okay.
Well, we're going to cover that.
Does wycoff teach that you never take a breakout?
No, and if you listen very carefully to what I said about half an hour ago, I said there's an exception, and there is. It's a wycoff principle, and it's called absorption volume, and it's a genuine breakout trade to the upside. It happens 1 in every 10 times, sir. I can take probably less than that. It's very rare that you get high volume on an up bar that's a genuine breakout, and hopefully when you come to seeing the wycoff stuff this afternoon, when we bring in the thrusts and everything, this very principle at the top here, with these high volume up bars like this, is very wycoffian. Because what it says here, all that Tom Williams did, when he did the wycoff course at the Golden Gate University not Golden Gate, it was in Park Ridge, Chicago. Everything that's in here is based on what he learned from wycoff. There is a slight difference in that he's added and embellished some of the principles, like you'll see up thrusts in here, but you don't see down thrusts, for instance. But I'm sure David and Gary will talk about down thrusts, and we'll talk about the wycoff theory. But it's very important to remember, I accept your point, that one thing, just because Rob's a great trader, just because I'm good at doing something, doesn't mean that it fits your trading style, which is why, and I accept that totally, which is why some people gravitate to Rob's trading room, some gravitate to mine. That's a different thing. What we're trying to say to you here, though, is the methodologies that we teach are aligned in the way that Rob trades, in the way that I do, and it's all linked back to Mr. Wycoff. And you'll see that this afternoon as we bring it together with Gary's presentation. Gary trades in our room as well. It all links back, but it's very important to see here why the breakout trade that you've been talking about, it's failed twice at the same price level. and it'll probably fail again. Now, let me, if I may, Rob, I'm just going to show the oil chart because we're a bit short of time. And, okay, sorry about that. Let me just put the oil market. I'm going to show you now the opposite. If you want to trade to the long side, I'll now show you exactly where to trade to the long side. And it's not at the top. It's the absolute opposite place I take longs. I'm going to show you now where you would take a trade based on going long. Okay. So can everybody see that at home? This is the oil chart, and this is where we just saw on the 5th of February 09, it's this bar here. We notice that the price has been trending down. That's important. The price has been coming down. The news about oil here was it was going to go to 15. There's too much supply. In fact, on that day, I believe, they had queues of oil tankers, lines of them, outside the United Kingdom. And there's pictures of it all over the news. I don't know if you remember this, but I always keep the news. In fact, if I go to my BBC account, I keep it I don't keep it just because I like looking at news, because I relate it to the chart. Now, if you want to buy a market and you want to be long, this is exactly where you do it. Not at the tops. You do it in the trend, as a market is trending, after you see what we call climactic action at a bottom. Now here, as it happens, to link in with what we heard from Andrew, we happen to know that at this day, because we talked about it earlier, JP Morgan withheld a large block oil trade. Why would that happen? Because they're bullish now on oil. And if they're bullish oil, probably some of the other big or institutions, like More Capital and others, are going to be bullish too. What do you see about the volume on that bar? See it? What do you notice about it? What do you all notice? Right. Okay. So if you're interested in buying, buy the market after you've seen that price bar. Now, what I'm going to do, I'm actually going to zoom in on it. So we're going to go all the way back, and I'm going to show you, then I'm going to bring you in, Paul, just to show some of your support lines. But this is exactly how you buy the market. It'll take a while to get back down there. And this is going to mark a market bottom most often, okay? But the trouble, I keep repeating it, the problem you're going to find, and in fact, we can probably do it with the one in, okay.
Do you know when the market's going to retest and when it's not going to retest?
When you say do you know it, you don't know it the day you see the high volume. You can't. Look, predicting a market and saying, I can tell you that definitely it's going to do that, no. There's always an element of risk. That's why the market contains risk. But what I can tell you is if you see, what do you notice about the volume on, now this is February the 10th now. Okay? So this is a year later. After we saw that block trade, professionals are bullish oil. They want it up at plus 100. So here we have a downtrend behind us. Suddenly, something stops the bottom of that down move, as we can see here. It produces, actually, a trade guide tells us, there is a climactic bar. That's what it says. Potential climactic action. Now, if you want to buy a market, sir, this is how you do it. You wait for the down move to end on climactic action. Not the breakout, the downside. So the market's falling. The news will be bad. Everyone else will be telling you to sell the market. Now, in this instance, the climactic action on that bar that you can see was enormous. Where does it close? Low, high, or middle, would you say? Middle? Middle? And does the next bar close up or down? So on that volume, just common sense, if that was all selling volume in there, how would the next bar close up? Now, the next bar produces for us a red indication in Trade Guide. It's not one you could short. It would probably tell you that they're just holding the price up at that point. But at some point, they're going to come down. Now, this is the setup. You want a specific, this is a principle. And this is my favourite. And if you ever see this, maybe in hindsight, I trade this at the New York Traders Expo. If you want to see that I trade real money live and take trades using this principle, The video's on our website. Go and watch it in front of 300 plus all the people out there. The same thing set up on the NASDAQ on a 5-minute and a 9-minute chart. This exact setup. This is how it works. So you've seen climatic action. The first thing you're going to want to do when you've seen climatic bars is you actually draw a line at the bottom of the bar. Doesn't matter what colour you want to draw. I mean, you can draw red, you can draw any colour you want, whatever your preference is. And at the top, just up here, we're going to do exactly the same thing. Okay. I'll put that in green. Looks like I deleted my lower line, but anyway, it doesn't matter. The principle's here. So you would mark the bottom of this as well, so I'll put my line down here. Right. So now you've got your Yao Ming down bar. Now, I've told you and advised you, I said, look, everybody, let's look for weakness on up bars. Now, you've said, hey, Gav, I want to look at where I buy a market. Where's the best place? If you see ultra high volume like that on the down bar, if the next bar's up, immediately, because the next bar is up, this is on a weekly chart, like Apple. This happened last year in Apple. Brilliant. You really are getting excited about the trade here. Then what we're going to look for is for us to start trending up, but this time the opposite of what we call no demand, which is an up bar, a weak bar on low volume. What do you notice about the volume on this bar here? That is very low. That's ultra low. That is exceptionally. That is less than a jockey, much less than Gary Fullett. That is real low volume. Now, what does that tell you at that level? It tells us very clearly that professional money have accumulated. Wycoff, you mentioned that you came to learn Wycoff. Well, this is what it's all about. Accumulation. Here, we accumulate at the bottom of this market after a downtrend has come into play. We happen to know that 5th of February 2009, they were so concerned that if anyone can read volume, they didn't want to report some of the trades. Think why that would be. They even got fined $26 million, or whatever the figure was. Think, why would you want to hide my trades? Because all the other, more capital and others, they're all in on it. They think, we found it. We know here at 70, we can get some more oil futures at the right price. But then, to confirm it, to send you a signal, if you can read volume, they then come down with a narrow range bar on that day. The price closes in the middle because it's so bullish because they've bought back here. And we call that a test after climactic action. On my other charts, on a different time frame, I had indicators on there. And that test was successful. And how you trade that, if you want to trade to the upside, is once you've seen that, after this, you put a buy order in, not at market on the test. You don't buy the test. You put a buy order in above the test bar. And if you're pushed into the market, in this case, you can see what it did to the chart. The buying, the Trade Guider software gives you signs of green diamonds, green bars all the way through, but the market goes all the way up. And all the way up here, you're going to see, and this is the one thing that we look for, is as we're moving up, we're going to look for signs of strength, as we can see here. Okay? So you disregard a red indicator in an uptrend in Trade Guider. You're looking for tests, or test in a rising market is another variation. And this is going to be looking to test supply to the background there. But when you've got that entry, you'll notice that you're going long at the bottom. That's where professional money buy. They buy on the bad news and they buy on the shakeout bars. And at the top, the breakouts, the false breakouts, they know that everyone wants to get long because they're risky. They want to take risk at the top. That's the worst place to go long. Now, let me be clear. Will you miss one or two breakout trades? Yeah, you will. If you see, however, a breakout on high volume and you see that test bar I've just shown you, at that right level and it holds, then you can buy it.
I totally agree with what you're saying.
Good.
But there's many stocks that you trade that have great uptrends, and they go for 7, 8, 9 days. They come back in 2, 3 days. They go up, pick up a prior high. Like it goes on and on and on and on.
Absolutely. I mean, and again, I would say to you there, hey, if you've got a good trend channel in play, okay, I'll show this, and then I'm going to bring. Yeah.
I could clarify something for you. Gavin makes it perfectly on the trade guider. If you look at what Gavin drew his.
Do you want to come and put? We're just going to bring Gary Fuller in now, who's going to just talk about who's a wycoff expert here. So hold on a second. Let me just put the headset on you.
Thank you. I don't mean to jump in on Gavin, but I do want to answer specifically before we go on further. You see the red line that Gavin drew, and you see it's kind of like a breakout. So you see that wide bar. I may use terms that you're not familiar with, but you see that small range bar, that absorption bar after the breakout. The next bar, you break out, right? So Gavin.
Yeah.
Okay, I'm sorry.
Yeah, which bar you
So the breakout, oh, look at your left. To your left.
Oh, here.
Right there. Okay.
Yeah.
So the next bar there is okay, a sign of strength. Okay. It's a small bar range, so obviously supply didn't come in the next day. The next bar, Gavin was telling you about a breakout bar, and Gavin says, don't buy it. wycoff was concerned with a primary buy, okay? So a retest of a breakout is the most proper wycoff buy in an uptrend, okay? So you missed the breakout as the market went higher, but look about 5 bars, come back 5 bars this way.
You can use the mouse thing.
Okay.
So you know
If you go, where are we at here?
Got it?
Where am I at here?
Okay.
Okay.
Just left click on any bar that you're referring to, and then.
Is it this bar here?
Yes.
Is it this bar? Okay.
That's it.
I'm not real.
That's it.
Okay. So you don't buy that breakout that we just had. And Gavin says you buy, well, a wycoff trader myself, I would buy that bar there. Okay? Because see the high volume, you say, oh, Gary, it's a high volume bar, and the market's lower. I will tell you that if the volume was high, which it is, the market did not take out support.
You're comparing that bar versus the Yale Ming bar because it's got to be relative.
Correct. Volume is relative. Volume is relative to the area that it trades in. Okay, but the fact that it came with all that selling, because it's a down bar, the fact that the market held support, told you someone, I call the word stuffing, someone was buying that market support. How can I prove that? If it didn't, the market would have fell apart. So your retest, as Gavin was via says, is great. The fact that you don't buy that initial breakout, there's not a great setup. If you buy the retest of that, that's your trade.
Yeah, I totally agree with what you're saying. I totally agree with the retest. That's the most conservative way to enter the trade. It's probably 90% accurate. Like it's probably, whatever. I don't have the quant on that data, but if you go to the low day, the Yale Ming day, and I don't want to belabor this point, but
That bar?
is that the Yale Ming day?
No, it's further back actually, but yeah, it's there.
Okay, so there's the Yale Ming day.
Yep.
That's the top of the bar.
Yep. There's the test.
Green line.
Mhm.
Okay, the red line is there, and further out, it's like, where was the test day?
Well, look, this is
It was a large volume day, right?
it's right in front of you here. Here's your first test.
So that's what I'm saying. That volume on that day has to be compared to the low day.
Absolutely.
Right. Okay.
Correct.
So
But
that
the
volume
key-
was taking
the
out
key-
low day's volume. What would you say that was?
I beg pardon?
If that volume was larger, what would you say?
That light volume day?
I think I know what the question is. Let me just be clear on this, just to repeat for the audience. Okay. So what we're saying here, and what the question has been is, look, we've got our Yao Ming bar just here. Yep, that's the one you're talking about. That's the first bar.
Test day has low volume,
the test of the top of the bar, which is what we're testing. We're testing it's no supply there because it closes above the actual spread of this bar at 74. It comes in. There's no selling pressure at all. There's no selling pressure on that bar. We know that because the next bar takes out the highs. It's called a successful test. Now, let's say you missed that. Let's say you didn't read it. They give you another opportunity to come down and buy it. And where it is, we've got increasing volume on this down bar, and the next bar closes higher. It's almost a little two-bar reversal, but it's what we would define as a test there. And what happens is the market consolidates for a few days and then breaks out another level. What I'm saying, look how long it took, though, from the moment of the test here, which is a very good one. If you ever see that, as I said, that's a very good setup. It then begins to move through. And what we have, this is where confusion reigns sometimes. I said to you that low volume testing after a widespread down bar is a strong sign of strength, which it is. But look what happens here as they come back down to the top of this bar. And what Gary's saying is the volume's now increasing on the down bar. It's closing off the low and the next bar is up. There has to be buyers coming back in. Even though you've got buyers and sellers there on that bar because of the big volume, the buyers are winning. No, that's not a failed test. No, this bar here is a widespread down bar, as we can see. The volume's higher than the previous several days. It comes down right into the high of where we saw the breakout bar here, which I've marked. It's coming back down, but it's closing up off the middle on that high volume, or off the low. Now, if that was selling in that volume, and it was all selling, you'd expect the next day to close lower. That's just common sense, yeah? And the next day closes up, correct? So therefore, we can infer that because of the strength in the background here, Yao Ming on the down bar, we've marked it out. We can look for breakout trades now. We have permission. Wycoff is there saying to you, hey, that's a long now. You've got permission because you've got climactic Yao Ming bar in the background. You're not at a top, you're at a bottom. And you're seeing testing. And those, the best chart I could show you, and we'll talk about it tomorrow, is the Goldman Sachs chart. If you drew a trend channel on that chart, sir, you'd see the market going up, coming back to the bottom of the trend channel and testing. And it's great buy. It would go back up, come to the bottom. And it would still break out, so you'd still get breakouts. But I like to buy the bottom of the trend channel, not the top. Because sometimes in that bull run, they'll come and catch you. They'll say, there's a breakout. Aha, got you. So the best and safest place to buy is as the price trends down at the bottom of the trend channel. Now, let me just bring Paul in here in a second. And before we were going to look at the S&P daily. Now, this is interesting. We spoke Tuesday or Wednesday for the first time. It's exactly what happened. I said, right. I said, what happened last Thursday, Paul? And he said, well, you decide. I said, well, listen. I said, I'll tell you what happened. I said, we were in the Trade Guide live trading room. And I said, we were looking at the daily S&P. And I usually leave the room open until 3 o'clock. And I actually decided this particular day to close the room off. All right? But what I did, the reason I closed the room off, in fact, I'll put up more bars than that. Okay, let's go back to Jan and March low. In fact, we can go back further. So what I'm going to do here, I'm just going to put a trend channel that we can see on this chart. Now, you can probably go back further here, but whoops, just bear with me a sec. Mm-hmm.
Try to repeat the questions as much as possible.
Yeah.
You guys start getting a dialogue back and forth, and the people are missing some of it.
Yeah, I know. It's always an issue that you actually have when we're doing internet broadcasting as well. But we'll try and be conscious of it. Okay, that was the line I drew. Now Tom Williams rang me, and this is what. Now you just saw me draw that trend channel. If you needed more information on trend channels, you just basically take the first two lows in an uptrend and the intersecting high. That's how Wyckoff would do it. You're looking at nothing too complicated. I'll be interested, David, to see what you have to say on trend channels here. But this is exactly what happened here. We'd come up to we were literally touching here the day before that shakeout bar, this quarter line. These lines are put on by Trade Guide Paul. And I actually said at the time, we're in a very dangerous area here because if professional money are pretty bullish here, we should see some sort of shakeout bar. Okay, now a shakeout, we don't know what a shakeout is going to look like or how it's going to materialise until after it's shaken out. But if professional money want to see higher prices in the future, they're going to shake the market out somewhere. So this is the day in question. Now, what was interesting, I don't believe the volume. I don't trust the volume on this, I have to say. But nevertheless, the range was there. And I think, I don't know how it's been done, but the volume that's coming and being reported here on these two bars is about 9 million contracts. So I'm wondering, there was a lot, if you talk about the news on this day, they were talking about billions of contracts, millions and millions of contracts being exchanged on the CME. But if I look at the volume on the two bars there, it doesn't quite stack up on there. So then,
your volume's wrong on that.
Hey, it may well. I said I'm suspicious. I'm suspicious.
It was 5.5 million.
Yeah.
5.5 million on the future.
Yeah. Well, it was on the day that we've got here. It's 3.6. This is from the exchange, so it's 3.6 there, and the next day we've got 5.68 million.
This is e-signal chart.
The data here comes from e-signal.
Yeah, and they always have their volume on the wrong bar.
Right, that's on the live edge chart, but on the actual bar here, and we can ask Craig about that later as well. Craig's here from e-signal, so we can actually find out. Yeah, we will have to deal with that one, Craig. So I'm looking forward to having you up at lunchtime here. But let's look at what I'm more focused on here is the range. Look at the Let's look at the range of the bar here, which is key. Look at the widespread, and look at where the price closes here on that bottom of the trend channel. And if we go and wait till Monday and go to smaller time frames, here's exactly what we would look for. If we're all together Monday, we would look for testing around the 11.25 area. Now, when Paul comes up and shows you his support and resistance lines, look at where they line up with some of the stuff we discussed, and you'll be amazed that it came down to that level. Now, there's all sorts of, even today I've just read reports. Somebody gave me the Wall Street Journal and said, look, read that, and they're saying it was one trader now. I mean, it keeps changing, the story keeps changing. Regardless, what we can see here is we know we've got an unusual range bar. Now, if we look at where we came down to in the background, it's exactly almost to the tick at the bottom of the trend channel. This time, however, the closing price on the bar, which is I'm more interested in, the closing price on the bar is right on the trend channel line that I just drew for you. Is that coincidence? No. It's actually because they've shaken the market down to a level. Yes, did it take out people's stops? Of course it did. But here's what happened. In the live trading room, prior to that big decline, I understand Linda Raschke was saying the same thing. We had a cluster of red signs of weakness at a level above here. And what was happening was, as the price was going up, the ranges were capping and capping, and the volume was getting lower and lower, to the point that I almost thought there was just no one left in the market, apart from all the one contract traders that are putting through one contract. And it drifted sideways, and it drifted sideways. And I said to the room, I don't like this. I'm shutting the room at midday. We're right in a place here. We're very vulnerable to a shakeout. I've got that on tape, so I'll let you all have that, so you know that's what I said. Now, was that prophetic? Yes, now I can see. Did I know it was going to happen within 2 hours? I had no idea. But the wycoff VSA principles were showing, as the market was moving to that level, serious weakness. And I looked at the currency charts as well, which I know Paul trades, and we could see this weakness appearing. So what I want to do now, I'm going to bring Paul in. We've got probably about another 20, 25 minutes here before we break for lunch, about 1:15. Paul, do you want to come and hook your laptop up? And we can have Paul's view now on using those lines. So just bear with us at home. We're going to just actually switch off the camera for a second while Paul logs in here. Richard, you might want to come up here and make sure everything's good with the microphones. Okay, so it'll be about 2 minutes here. Let's get rid of this. Yeah. You haven't got a headset, so you might want to plug that one in. What I'm going to do is you already connected to the internet there. Oh, yeah. Oh, okay. And you'll need to project and go to... No, that's all they've provided. Yeah, of course it will. We're finding lots of solutions today. It's great. Yeah, let me know when you're projecting. Oh, no problem. Change presenter. Perfect. How's that? Okay. Let's just get you set up with this. Okay, we've got visual. And do you want to do a sound check for the people at home? Just make sure they can hear you. Just switch the mic on and go to webinar if you can. Is it? Yeah, just switch the... If you click on go to webinar, the actual... Oh, there you are. Yeah, just switch your mic on. Just do a sound check. Okay. Testing 1, 2, 3. Yeah, let's just make sure. I think it's good. Yeah, it's going to use that one as well. It's going to use your one and this one here I've got in my hand. Okay. Should you do another sound check? Because they're saying the sound is... 1, 2, 3. You have to speak up a little. Can you speak up a little bit?
Okay, can you hear me?
Yeah.
Just for, I guess, people in the room here, I'm actually going to keep this really brief.
Hold on. What we're going to do is we're going to plug this headset here.
I mean, this is plugged in, right?
What it's doing. Picking up. It's picking up your... If not, I'll just use... Actually, that's probably easier. Yeah. All right, we'll sound check now.
Okay, testing 1, 2, 3.
Testing 1, 2, 3.
Testing 1, 2, 3.
Much better, they said. Good. Okay.
Great, thanks.
All right, and let's give you this mic, get the headset here. Okay, right, everybody, sorry about that. Just had to switch laptops over, which we have now done successfully. Let's just get out of this. handle that as well. We're ready to go.
Okay, I'm hoping everyone can hear me. God, I feel like I'm on the space shuttle.
Like a pilot, don't you?
Yeah, I do.
It's on. Is it on? Yeah, it's on.
Testing.
Good.
Okay, I'm going to keep this really brief for a couple of reasons. Number one, I'm really hungry. It's like 1 o'clock, and I thought that you guys were going to lunch earlier. And number two, someone made a kind of interesting point a little while ago. In fact, I think the chap's not here at the moment, which is you're actually here to learn about wycoff. And I'm increasingly aware that what it is that I do is not wycoff. And so I'm going to keep it really brief because some of you might have an interest in this, others may not. But I'll go through it and see if there's any interest. I was speaking to some people during the break, and they were asking me whether I could put up a couple of intraday charts. And, in fact, there's a chap just come back there now. I was just explaining, I'm going to keep... I'm sorry?
They said there's no sound. Is your mic on? Switched it on and go to webinar. Yep, I think it is.
Can you hear me?
Do it again. No sound.
Paul to earth. Huh? That's what happens when you run Windows on an Apple.
Sorry about this. This is your plan B here. We'll plug you back into here.
We're going back to carrier pigeon.
Welcome to GoToWebinar.
That don't sound good.
Web events made easy.
They're not that easy.
Right, now try.
Testing 1, 2, 3.
Okay, try again.
Hello. Testing. I actually have a speeded up voice playing back in my ear, just so you know.
Okay, now try.
Hello, testing 1, 2, 3.
Yep. Oops. Try again.
Testing 1, 2, 3. Sounds like I'm on helium.
Okay, good to go.
I'm good?
Yep.
Okay, just so you know, I have voices in my ear.
Okay.
It's very distracting.
That's probably...
I can't do this. I've got that voice in my ear. Okay. Right, so I'm going to keep this really, really brief. He said 10 minutes later.
Say hi, Paul.
Hi, Paul. This is chart silver, and actually what I was just going to say, you'd stepped out. I'm going to keep it brief for one other reason, which is this isn't wycoff, and I'm really conscious that you guys are here to learn wycoff, so I will keep it brief. This is a chart of silver, he said the third time, and I'd made a reference earlier to the fact that even though Andy and I are potentially having a strategy in terms of the bigger picture, we're very happy on a tactical or intraday basis to trade against that strategy. This is a good example of how we'd do that. Silver, I'm just going to zoom out slightly here because I just want to show you. This is a set of median lines that dates back to 15th of April. And again, I made a comment earlier, which is just because a lower median line breaks doesn't tell me to throw a fork away. It just tells me, depending on what frequency or what is the path of price, is it working? And look here. We have resistance at the quartile, resistance at the quartile, resistance at the quartile. So now I know I have the path of price. That's all I ever look for is the path of price. If you just want the trend, it's up or down. But if you want the path of price, it's up. And what is the slope or frequency? And that's working really nicely. We keep falling to the lower median line.
Sorry, just to stop you there. Sorry, mate.
Yeah.
But look, don't know how that is showing. And
I think that's your screen. Is that not your screen? Because you're putting your screen up.
shouldn't show though, but yeah, just reduce it.
Yep, that's your screen.
Yeah, sorry about that.
All right.
Okay, there you go. That's fixed.
So the lower median line provided us with consolidation in this area before it finally gave way. You were talking about...
I think the smart money...
It's Goldman Sachs, isn't it?
Playing games with us.
I told you I was hungry, but hang on. Oh, I'm no longer the presenter.
Okay, now what you need to do is I need to hand it... Yeah, someone knocked you off. That's weird. Okay. Okay, try now.
Gaudy baby.
Yep.
We good?
Yeah. You got physically knocked off, just so you know. I don't know why.
All right, that's Andy.
Okay.
Okay. We consolidated at the lower median line before we finally fell through. I don't look for exact touches. For me, this is a quartile bounce back up, and we actually had a rejection from the lower median line. All of this is telling me that we have got the path of price, we've got frequency. This is actually pretty bearish. Let me just take a copy of this line down here. Hang on, let's select it and copy it up to here. And all I want to show you again, just to prove, and I wouldn't even put this on the chart normally, but again, this is just showing the path of price. But look where it is, it's below the quartile. That's a bearish indicator. Now, I don't know how some of this relates to what you guys do in terms of...
It's called shortening of the thrust.
Thank you. Oh, you're not making a personal observation? Or? Okay. A shortening of the thrust.
That's it. It's wycoff. Total principle.
Okay.
Lack of upside progress.
Yeah. So, and again, it's about the lack, in our own methodology, it's a lack of efficiency within the fork.
Or diminished momentum.
Okay, thank you. Diminished
Do you
momentum.
want to just let the audience know that David Weiss was just confirming that what you're
David
saying
Weiss was just confirming that what I'm showing actually relates completely to the wycoff methodology.
It does.
So what we're seeing here is where we'd had 3 tests of the lower quartile, now we're having 2 tests below the quartile. We can't even make it up as far as the quartile. And sure enough, we fall pretty quickly down to the first warning line. The warning line is not some arbitrary line that I've just drawn on the chart. It's exactly the same distance from the lower median line as the lower median line is from the median line to the upper median line. A bounce there, we fall through, up again, and now again, once again, we reject off of the warning line. When we finally bottom, this is not a trade. It's not like you could have got in long on silver at this point here, but once it comes back up and starts to move back up, one of the other formations we use, again, I've mentioned it, the ABCD, very simple formation, predicted a top at 1982. And I think we went to 1984 before falling back, in fact, as low as 19. So that was a pretty significant move back down. But what's also very interesting, and it just shows how the markets are in harmony, effectively, is this. See this resistance here and here. Where are we? We're back at the quartile. Let me scroll the chart back. If you want any further evidence that the fork is picking up the path of price, you've got to touch here, here, here on the quartile, here, here. This time it coincides with a D target, and this is one of the times I would short an uptrending line, because now I have highly proven line, that quartile. We've hit it 5 times now, plus we're now at a D target. I would be expecting a pullback from this area. And you could have been getting short there at the D target. Here's your problem. Where's your stop? Well, actually, 2 problems. You don't have a stop. You're making new highs, so you can't hide a stop behind market structure, i.e. prior highs. Secondly, it's silver, so if you put a stop in, it's going to get flushed. But that's exactly, this chart is a good example of how we would have actually shorted silver against an uptrending market. We're making new highs, and that would have been a short. And actually, that goes back to, I know you were talking a little earlier about like breaking out and getting in on new highs. For us, this was an example of when to get short on a new high. I look at the S&P daily. I'm just going to zoom in slightly.
Paul, just so you know, the comments from here is that's very wycoffian, and yeah, that just confirms what you've said. So yeah.
Okay, cool.
Yeah.
Okay. Okay. So the S&Ps. I do not trade the S&Ps. I haven't traded the S&Ps in 2 days. In fact, I only trade currencies. Annie only trades metals. We don't trade this. We only chart the S&Ps for the purposes of putting out analysis for clients. We have what's called an action-reaction line. And actually, the orange line is an action-reaction line, and I want to show you where it comes from. Unfortunately, I've given the game away here, but look at this particular, it's a standard Andrews pitchfork. And what we do is this. We have a series of highs, which it's not rocket science. We have a trend line. And an action-reaction line, we would simply take a copy of this line and see whether it's catching action elsewhere in price. And in fact, you can see this low to this low was an exact touch. So we would have not had this action-reaction line until somewhere around here. Once we start to see a series of highs in a line, then we would draw in this line and copy it to see where else we're catching frequency, the path of price.
And wycoff terms, that's called a reverse trend line.
Okay. See, there's a lot of parallels, and I think that's really one of the reasons you wanted me to go through some of these charts.
When you were getting up there saying, I don't think this is wycoff, trust me, I wouldn't bring you here if I didn't think
Well,
you had what you showed me the other day.
See, the funny thing
when
is...
David picks it up later on, and Gary, I think you're going to go, actually, that's totally what we're looking
But no, actually, that's it. That's exactly. Someone's actually just made a comment, which is you just need to combine these. Yeah. Sorry.
That's not necessarily a reverse trend line because you're using parallel lines there. You really don't know what that line is going to be at the top.
Correct.
You drew that from
correct.
Different parallels.
Yeah.
It turned out to be that way.
Well, see.
You started at the top.
Yeah, I started up here. I would have drawn. Okay. Let me make it clear. Once we have this series of highs, it's a pretty visually obvious trend line. I would have drawn in the line, which is exactly what I did. I drew in the line joining these highs. Once I do that, I simply copy it and draw it. And I actually, it's no more difficult than this. I literally move it around on the chart until I see are there other places where I'm seeing frequency on that slope. That's all I do. And you can see here that we actually have a great low to a low. So I'd left that line in, and I just leave it there. Whether it's going to come in useful at some point in the future, you know what? Unless you leave it on the chart, you'll never see it. And this is what happened. I also have my blue pitchfork that I've been following for months and months at this point. And you can see that the sliding parallel, it's starting to get a little bit messy around the top of the sliding parallel, but now we're not quite making the sliding parallel. So what happened was this. Several weeks ago, S&Ps, as you all know, moved up, and on the morning that it touched, this, in fact, I've moved the line now. Sorry. Let me make it touch the highs again. There you go. On the day that it touched this action-reaction line, that was a Friday, I put out analysis at 7 o'clock in the morning saying, today is the day I expect that we're going to see some sort of a reversal in the S&Ps. 90 minutes later, there was an announcement that there was an investigation into Goldman Sachs, and the S&Ps fell. So, prophetic, I think, was the word. Did you say you were pathetic or prophetic?
Prophetic was the
okay,
word.
sorry,
Pathetic
just checking.
Sometimes.
Checking.
I just want to show you a comment so you can all see, so you can see this. Because Peter's one of our long-standing customers, but he's actually a wycoff trader. I don't know if you can see this at home. You probably can't. But it says here, this is for you watching your presentation, I'm a wycoff trader. And I know he is. And he says, although I don't use Andrew's pitchforks, I have many of these same lines on my charts.
Okay. And the only thing I'll say is, a wycoff trader would say that this is very wycoffian. Mm-hmm. From my perspective, a lot of what you do relates very much to what Babson did. Yeah. So it's about perspectives. Sure. So we reversed, came back down. In fact, we dropped down to like the 1180 area, came back up. And on the day that we hit the action-reaction line again, I said, look for another reaction at this line. And I forget what happened on that particular day. The markets fell back down, and it gave a second bounce. At that point, I noticed, see if I can do this so you can actually see it a little clearer. I started to notice that the bottoms, the pushes to the downside, were forming potentially a second set of action-reaction lines in the downward direction. And we pushed back up. On the day that we pushed up to here, I'd made the observation, and this was the observation, and maybe there's a parallel within wycoff.
If people follow wycoff, those two bars that he explained is last point of supply. It's called LPSY. It's the last rally before breaking of the ice. So we're describing is wycoff.
Okay. So an observation I made at the time, though, is I'm sure everyone or a lot of people have heard 3 drives to the top, 3 drives to the bottom. And I'd made an observation. If this is your first drive to the top, first drive back down. Second drive back up, second drive back down. When we started rounding over here, in fact, I remember, I think almost word for word, my response was, if this is the third drive back to the top, we're screwed. And we have failed to take out this high. We have failed to touch the action-reaction line. It's hugely bearish. And if you look at one of the things I look at, and actually one of the things I did notice is looking at Gavin's charts. He has 3 elements on each bar, the high, the low, and the close. That's all I look at, the high, the low, and the close. So that actually I kind of thought was very interesting when I looked at his charts earlier. If you look at the close on that bar, the sellers have basically closed it at the very bottom of that bar. Back down we go. For the very first time, we're breaching this action-reaction line, the upper red action-reaction line. We bounce a new line I now draw in, pull up, and in fact, on that particular morning, I'd made the comment, if we break the lower action-reaction line, look out below. Now, here's where I slipped up. That was the extent of my analysis for that morning. If we break this line, look out below. What I should have done, because I screw up just like everyone else does, what I should have done is zoomed out. Because if I'd zoomed out, I would have seen that the pitchfork bottom, as well as the action-reaction line bottom, were there. Now, I didn't see that until, I swear to God, it was the following day when I thought to zoom out on my daily chart, and I spotted that. And then I spent the next hour kicking myself. And which brings me back to something I said earlier. You can have the best charts in the world, but if you don't get a trade out of them, you know what? You might as well use it as wallpaper. It's pretty pointless. So the chart worked out really nicely. It seems that there's lots of parallels to wycoff. It caught the bottom. I mean, you can see that is to the pip. It caught the bottom. I didn't look at it till afterwards, so it didn't really help me. I don't trade it anyway. And then let me look at just one more, just to show, and I think I showed an intraday. If I haven't, I'll jump back. This is gold. Someone asked me to look at a bigger picture of gold. This is a weekly chart for gold. Got a pitchfork, got an ABCD formation. Something I haven't mentioned on the ABCD formations, I don't know how many of you have heard of Trident, which is a system put together by Charles Lindsay, and it relates to ABCD formations where on the CD leg, you will have a reaction on the midpoint of the CD leg. So A, B, C, D, and halfway up the CD leg, you'll get a reaction. And if you get a firm reaction on the CD mid-leg, it tells you two things. Once you've taken out the P to the upside, P is the midpoint, you have a high likelihood of reaching D. You have a high likelihood of seeing a reaction once you get to D. This is the ABCD. Benson's great, but sometimes. Okay. A, B, C. Look at the P reaction here. So we come up, touch P almost to the pip, and pull away. We then pretty much gap through the P. The fork, I'm happy at this point, is working because the upper median line has given me a solid rejection. It drops straight to the median line, which gave me a very strong rejection back in the up direction, and we're headed back up. If we get to the upper median line, I know everyone thinks gold's going to 5,000, 10,000, whatever. It's irrelevant to me. If we get to the upper median line, I'd be cautious. If we spike through the upper median line and touch the D target at 1344, I'd be very, very cautious. And I just want to show one more example of that midpoint reaction. This is one that I'd actually sent out the other day, and it's actually working out really well so far. This is the Swissy. This is the Swissy on a weekly chart, and it's kind of difficult to see this, but if you look at, you've got an A, B, C. This spike here was last week.
Sorry, quickly, the Swissy, no, some currency traders, we've got stocks traders, they don't have a clue what the Swissy is. It's Swiss franc, of course.
Excuse me, I'm sorry. Swissy is Swiss franc, Aussie is Australian dollar. Yeah, absolutely. Cable is the pound.
The dollar.
That's it. So, yeah, absolutely. It's one of the main pairs. It's Swiss franc versus the US dollar.
Right.
In this instance, when the vehicle is moving up, the Swiss franc is weakening. And what you can see here is last week, this is actually on the Thursday, the Swiss franc moved up and topped within, I think, 3 pips of the exact P on a weekly pattern. And it pulled all the way back down to like 110.70. And in fact, it's been down as low as 109.20. So we've actually pulled 300 pips back from that P before moving up quite strongly again. In fact, we're now at the high, the recent high, in fact, for the last 6 or 7 months. Tells me two things. Number one, we have a high likelihood of getting to D. Number two, if we get up in the 125 area, bearing in mind that's like 1,200 pips away, I'd be looking for a reversal somewhere in that area. These P reactions on ABCD, they're very, very reliable. And someone asked me about the yen. last one, because I'm hungry. This is a modified shift. I told you on a modified shift, the A pivot, in fact, let me just check where the A pivot is on this. It's normally a very, there it is, it's up here. This is the A pivot. So the A pivot has been shifted down 50% and across 50% towards the B pivot, which is here. The fork seems to be working, and what tells me we're working, before we get to here, what tells me we're working is this. Look at the bounce on the median line. An exact bounce on the median line. I don't know this to be the case, but I'm going to draw something in, being a bit speculative, oops, here. But it looks to me as if we also have a sliding parallel here. Okay, we do. So again, this is the path of price. Once you know you've got the path of price, you can be relatively comfortable that the fork or the set of median lines are working. We came up, touched the upper median line in the last week, and we've actually fallen pretty precipitously. In fact, we were down from like 95, basically, being down as low as 88, 700 pips of a drop. That's on a weekly. Let me drop down to, in fact, I didn't even know I had a fork on a weekly for the yen. I just want to drop it to a 240, though, because I want to show you the... Oh, and by the way, we were talking about retests. I call those switchbacks. This is a horizontal switchback in the euro. Came down, moved back up, double tap off of a sliding parallel that had been created back on the 13th of April. That was the trade. Short there with a stop above the first tap. We'd been getting you in around 133. Fell, came back up, and did an exact switchback off of this prior low. And again, I think you've referred to something similar in terms of wycoff. But the yen, lastly, okay, hang on. I'm trying to work out how I can describe this without getting too... Okay. We have what I'm looking at here is the lower median line, i.e. the lower line, this thick lower line on the blue fork. This is a working fork. Median line, double tap. Not able to make the median line. Lack of efficiency. We're running out of breath, running on that treadmill. We haven't even made it to the median line. And when we come back down, we come back up, we don't even make it to the quartile this time. I mean, and these are the signs that I look for a market rolling over. Our first move up, we've gone to the median line. Second move up, we didn't make it to the median line. Third move up, we didn't even make it to the quartile. And now look, straight down through the lower median line. But here's what I really wanted to show. Look what happens. It falls through that lower median line. Can't get up through the median line. Can't get up through the median line. Can't get up through the median line. And on each of these instances, I highlighted, this is the area to look for weakness. And 3 times it fell away. And in fact, at that time, it was up at 93.60. We've been down like a couple of hundred pips below there. Again, I'm sure this has a lot of parallels in wycoff, but I just wanted to show a couple of examples there of the methodologies that we're using. And I'm sure in your own minds, it's very, very similar in terms of wycoff. That's all I really wanted to show for now, Gavin.
Okay, let me just type in here. Excellent.
I have one question.
Sure.
How do you draw Andrews lines? How do you know where to start?
Okay, basically what I do is this. Let me go.
I've seen this indicator. I don't use any indicators.
Sure.
I know that this is one, and a friend of mine talks about it all the time.
Okay.
But I don't know where you start to draw.
Okay, so I've been basically asked, how do you choose the points from which to draw the pivots of a pitchfork? Okay, and here's how I'd answer that. For the A pivot, I typically start from a very obvious and notable swing high or swing low. I tend to get, shall we say, inventive with the B and C pivots. But really what I'm trying to do is this. I'm trying to catch the path of price, which I keep repeating. But it's the path of price that I'm trying to find. So I'll use my major swing high or major swing low for an A pivot. Then I'll draw, and I can use a variety of Bs and Cs until I can draw a fork in, and I start to see that I'm catching frequency. Once I know I'm catching frequency, I'm happy. And that's really what I'm trying to do. And actually, this is probably not a horrible example. This is the euro-yen. This is a fork that I've drawn from the very high. And actually, the B and C are fairly obvious pivots. And the way I do this a lot more than anyone I know, I use quartiles for support and resistance. I don't think many people look at them. They typically look at the primary median lines. For me, that's a perfect quartile bounce. Quartile support all the way down here. And I want to show you something very briefly now, which is this. Can you see that even though there are bars dropping below the quartile, look at the closes. The closes are being all capped at the quartile. You know, we've got a couple of bars here, but basically this quartile is working perfectly. And if you're looking for like tick precision, you actually do find a lot of tick precision on a lot of these charts. But for me, you know, this is good for government work. I mean, that's close enough. That's quartile support. We've got a sliding parallel working nicely. Look at the slope. It's catching price. Back to the quartile. Up to the first median line. Let me get rid of that line. We don't need it. Back up to the first warning line. One touch. Second touch. That's a short there. Stop above here. Fell off a cliff.
You broaden your channel, so to speak, off the B and C lines with parallel lines.
Yeah. Okay, so yeah, thanks. So basically what I've been asked again with David is, so if a line is exceeded on the fork, I simply draw in additional lines, and that's absolutely true. I expand, but using the same slope. And really, that's what you're always looking for, is the exact slope of price. And hopefully, it's pretty apparent on that chart that we're catching the path of price. And you can see, look, here's another one now. There's a fork. For me, that's perfectly catching the path of price. Two beautiful tests, straight to the lower median line where we get a great bounce. Two more tests at the upper median line, straight back to the lower median line for two more bounces. Where do we fall when we get such volatility last Thursday? Out to the first warning line before we go straight back up. Where do we go up to? A warning line above the fork. I mean, this is so catching the path of price. Is it giving you like pinpoint precision on turns? Maybe not.
Question from Sol, I think he's in Malaysia, I believe. But where do you enter your position?
Okay.
Where's an entry there?
Well, here's how I trade median lines. Actually, let me go back to the...
Well, we're going to wrap this up in about 2 minutes because the food's just been arrived. So.
Oh, in that case, it's urgent. Right, now, so two things. Number one, I 98% of the time will only short downtrending lines and go long in uptrending lines. Number two, I will not take a trade unless I know three prices: my entry, my stop, and my exit. I don't scale in, I don't scale out. I lie. Sometimes I'll take profit at the first level of resistance. Let me give you one example. This is a downtrending fork. I'd be looking to short the pound. I'd be looking to short the pound at the upper median line. This, in fact, I mentioned the other day on another webinar. I was 5 pips above the high of the day. I was waiting at the median line with my stop above a prior high. Once you see a significant top like this, there's a pretty good chance that the sellers are still waiting at that level. You hide behind them. You hide your stop behind other people. So you'd be shorting at the line, stop above prior high, and where would you take your profit? Typically, you'd be taking your profit either at the median line, or you take half off, or you might want to ride it down to prior lows, down in this area down here, or to the low median line. Quite often, there are multiple prices you could take profit, but I'm a wuss. So what I like to do is to take some money off the table as soon as I can, because that way, even if it reverses on me, I'm not going to have a losing trade. I might have a small winning trade, but you know what? I would rather have lots of small winning trades than a couple of big losing trades. And here's the problem with, I would suggest, with any system. I don't know where the pound's going on the next bar. I don't believe in any... I mean, you can kind of have high probability. I think this should happen. It looks like that's going to happen. No one ever knows what's going to happen on the next bar. The fact is, some news could come out of Downing Street and the pound could go up 100 pips in 5 seconds or down 100 pips in 5 seconds. So all this is about doing is trying to give you a high probability entry with a low risk stop. So if I have a great second touch off of an upper median line, but I've no nearby stop, I won't take the trade. I need a tested line, I need a stop that is somewhere nearby, and that's how I'll enter the trade. I don't like to enter the trade in no man's land in the middle of the fork, even if it looks like we're about to break down by 500 pips. You know what? There's always another trade.
Yep. Can I ask you a quick question, Paul? If somebody wanted to learn more about this, is there a classic text or or two that you would recommend?
Yeah, in fact, there's an action-reaction course which was put together by Dr. Alan Andrews, who derived the Andrews pitchfork. And if you do a search online, you can find that. Timothy Morge, who runs the company Market Geometry, he actually provides education in relation to some of this system, not all of it. The ABCD with the P reaction, that's Rick Ackerman at Hidden Pivots, rickackerman.com. And obviously the analysis that I put out every morning would actually combine both of these methodologies, the market structure, pitchforks, median lines, action, reaction lines, energy points, which I haven't even shown, which are basically when you have two forks that cross, where lines cross, it's an energy point, and it attracts price to it. So, yeah, I mean, the analysis I put out every morning includes both of those methods. So I said I was going to be brief. I wasn't as brief as I thought.
Food time. Righty-ho.
Yep.
Okay, let's have the headset back. All right, everybody. We're going to, everybody online, we're breaking for lunch. We were overrunning a little bit. Well done. Great job, Paul. I hope you enjoyed the session there, session 2. Next session is Gary Dayton, so we're getting right into the wycoff principles there. So we're looking forward to that. We'll get you set up in a second. And we'll be back for lunch in an hour, so at 2:30. Okay, so we'll get going there. So thanks very much, everyone, online. We'll see you in an hour. And for those of you that only booked for the first keynote sessions, if you want to hang around, you could just email Richard Bednall, my colleague. He'll give you a telephone call if you're online, and we can set you up for the rest of the sessions. Thanks, everyone. Bye.